Awesome. So we'll go ahead and get started. It is the 6th of December, 2021. Thank you for joining us as we do our monthly market insight for the month. Nora, will you go ahead and lead us off?
Yeah. So hi, everybody. Welcome. Happy December. We didn't meet in November, so kind of lots to talk about and catch up on. So first, Sean, let's talk about the markets. We've seen a lot of volatility in the last week or so. Looking at how the market's performing right now, we're actually up, but we can kind of factor in three things that have played a role in some of the volatility. One being Omicron. The market or the media is creating a lot of fear in that. There's a lot of uncertainty, so investors are reacting towards that. Secondly, inflation. And we've talked a lot about it, specifically on these monthly market insights. It's currently at 6.2%. So we'll kind of dive into that a little bit. And then thirdly, some mixed messages in terms of the employment rate and jobs report that came out in November. So to kind of put that in perspective, we added about 210,000 jobs in November. We projected 550,000 jobs. And when we look at October's number, that was just under 550,000 jobs. So we're hitting a number a little bit lower than expected. But then in addition to that, when we look at employment rate, that's down to 4.2%. And so if you remember way back when coronavirus was all hitting, we lost a lot of jobs, Congress was saying, hey, it's going to take till 2024 to get that number to 4.2%. So we've already hit that. So a lot of kind of mixed data and messages in that. So all of that saying the markets have been reacting to some of that information. So Sean, kind of tell us a little bit more about that, dive into those factors and what investors can kind of plan for as we get into 2022.
Yeah. So, one of the things that we've continually said is that coronavirus is kind of still that one big market impact that we just can't factor in because we don't know if there's going to be a Delta variant, an Omicron variant. We don't know how severely it will come back. We don't know if that means business would be shut down. So we had a new variant discovered. We started to see some travel being more restricted. And so I think the markets got a little bit scared there. And so we've seen just incredibly large movements, both positive and negative. We had the worst day of the year trading wise, the day after Thanksgiving, which is supposed to be a pretty boring day. Traders take the day off, markets close at 1 o'clock, nothing should really happen. And the S&P lost over 1.5% in one day. So we see all these big time movements. Monday, the markets come roaring back. The next day they fall. Today, we're going through all of last week. Markets were all over the place. Today, they're back up really, really strongly. So we see these big movements, both positive and negative in the markets. One thing we're saying is just stay disciplined, right? Don't try and do anything crazy during all of this movement. Again, it is because there's so much data coming out that is contradictory to one another. It might be really bad one day, really good the next, and the markets just don't really know how to react. But if you stay patient, right, the markets have been very, very good this year, right? So we've had a lot of uncertainty throughout the year coming off the election. 2020 has ended up being a really, really good year for the markets. So we have to stay patient knowing all that. So one thing that we're looking at through the future of the year is really what happens with coronavirus. Are we going to continue to, kind of restrict traveling, shut down jobs? I think what we did learn from early 2020 is it's not going to be as extreme as it was then. And that's because we now understand the data a little bit more. We had no idea what was happening in March of 2020. So we're not going to see a huge 35% drop like we did at that time. But the markets will continue to react as we get different news, and that's okay. When it comes to all the kind of the different information that's out there, jobs reports, unemployment number low, understand that there's a lot of different factors that go into that, right? So when we talk about the unemployment number, sometimes those things won't include people that stopped looking for work. And so all the data needs to be looked at in aggregate, not just one single data point. And one of the other big things that keeps coming out, and what we saw happen about 2 weeks ago, was the Fed say, for the first time, they admitted inflation is not transitory, right? So we've been saying it all along, all year. They don't have this under control. It's supposed to be at 2%. It started getting into the 3, 4, 5%. We just saw 6%, which is the highest rate of inflation that we've seen in over 50 years. So over the last 12 months, inflation has been at 6.2%. So what we've been saying all year, and it is more true now than it was before, and it will continue to remain true, is you have to get cash into the market. People that are sitting on $50, $75, $100, $200,000 cash, they're losing out to inflation. They're losing purchasing power every day. People think that a savings account that's earning 0.5% or 1% is a very safe place for money. And I say it's actually the riskiest because you guarantee yourself a 6% loss. And if I told people as a financial advisor that I can guarantee them 6% loss, I promise you that I would no longer have a job. But when you put money in a savings account right now, that's exactly what's happening. We go back and look at some of the data. We don't know how long this will last. It's not transitory. The Fed said they're going to get rid of that word. I think it's coincidentally enough after Jerome Powell got appointed again that finally he was able to admit the truth maybe. But now we're starting to see that this discussion is going to happen a little bit more. In the 70s, we saw about 2 decades of inflation. After World War II in the 40s, we saw about 1 decade. So I don't know how long it will last, but it's probably not going to be just 1 year. So you've got to get money in the market. We don't want you losing 3, 4, 5, 6% a year over the next couple of years.
So Sean, you talk about what as investors we can do in terms to combat inflation. What are some things that we're monitoring in terms of what Congress may be passing? You know, we've heard talks about reducing stimulus package. What things can the Fed do to combat inflation as well?
So one of the biggest tools that the Fed has is they have the ability to raise the interest rate, right? And so right now we're able to buy a house at 3%. We've seen people get 2.25% 30-year fixed rates for about a week. That was pretty amazing. But a lot of people even get able to get houses under 3%. So one of the things that will happen is the Fed will raise interest rates. So what we see right now is we've been seeing lots of stimulus, lots of things to spur demand. And right now we have an over demand, right? We have lots of people that want to buy houses, lots of people that want to buy cars, but we don't have microchips. We don't have a lot of houses for sale. And so all of those things are a limited supply. The same is true. We've got people at the ports. We've got trains full of goods and no one there to unload them, not enough truck drivers to drive them. So we didn't see any stimulus to spur supply, right? So we didn't see any incentives to have truck drivers driving. We didn't have any incentives for people to unload the ports. And so we've got a lot of demand and not a lot of supply. And that's why we see this inflation occurring. So until that supply catches up, it's going to continue to be exacerbated. So I don't know when that will happen or how it will be curbed. But what the Fed can do to try and slow that demand is raise interest rates. If now all of a sudden I could buy a car at, you see these 0% or 1 or 2% interest rates, now all of a sudden the Fed raised the interest rate, banks have to charge more of an interest rate. And so now all of a sudden to buy a house, you're not going to get a 3% mortgage, you're going to get a 5 or 6% mortgage, right? And I don't know if it'll be that extreme. I don't know how long it will take, and I don't try and guess at those things. But that would just be one kind of inference that we'll start to see interest rates rise so that we can slow down some of the demand to kind of stop some of the inflation.
Yeah, and Sean, and those have been a lot of hot topics that we talked about, especially when we meet with clients in the fourth quarter. So if you have any questions, things that you're worried about, don't play too much into the media. Make sure you have a good strategy in place. If you have any questions, we're here for you to bounce some ideas off of or just as a reference. Talk about fourth quarter. We round out 2021 as we head into 2022. Taxes are also a big topic of conversation that we've been having, making sure you're meeting those maximum contributions for 2021 and plan for those changes in 2022. So Sean, talk to us about what investors and what should we be prepared for in 2022 and what should we make sure is done by the end of the year?
Yeah, so fourth quarter for us, right? We always have that tax strategy meeting with our clients, make sure that they've, fully contributed to their 401ks, fully contributed to their IRAs, do a backdoor Roth IRA if they're in the income level that needs to do that. And then we'll just give them an update on some of those rules as you talked about, Nora. So for IRAs, the contribution limit in 2021 is currently $6,000. That stays the same in 2022. There's a catch-up contribution of $1,000 on top of that for people that are over the age of 50. So that's $7,000 for your IRA or your Roth IRA. That won't change going into 2022. One of the things that's going through Congress right now is eliminating that backdoor Roth IRA kind of loophole. And so that's one of the things that we're monitoring. But again, we don't get too worried about tax law changes because one thing we know is certain, not only is death and taxes certain, tax law changes are also certain, right? So there will always be changes to the tax law. We don't want to make drastic decisions just because those tax laws are changing, but they will change and they will change again in the future. But right now, Roth IRA conversions are on the table, trying to get all those in for our clients for 2021 while it's still an option. When it comes to kind of 401ks, 403bs, TSPs, those accounts, currently the contribution limit for 2021 is $19,500 with a $6,500 catch-up contribution once you get past age 50. We get a $1,000 bump in the employee contribution. So instead of $19,500, it goes up to $20,500 for 2022. So make sure you update your contributions with your employer to get that maxed out. And then that catch-up contribution remains the same at $6,500 for people that are over the age of 50. So really, those are the big things that we're meeting with clients, making sure that they're investing money in the right places, given their tax situation, making sure that they get those IRAs, 401ks fully funded so they can reduce that tax burden or come up with a new strategy, right? Depending on how things change for you. We see a lot of people changing jobs around the holidays and to start the new year. So there's new benefits, new, contributions and different options that are available for you. So just putting in a good strategy for everyone as we wrap up the fourth quarter here.
Yeah, when we talk about benefits, one of the things that we talk about too is if your employer offers a high deductible health insurance plan, an HSA may be available to you. And a lot of people aren't aware, HSAs can be invested. And so they're what we call a triple tax advantage. If you have that, certainly, and you're able to take advantage of it, you should. That amount also increases to $7,300 for 2022 if you file jointly, married filing jointly. So another thing, just make sure you're aware of some of the changes, the updates, take advantage of what you can. If you have questions, reach out to us. We'll come back here, Sean, in January of 2022. So everybody have a wonderful holiday. In the meantime, we're here, we're open. So just make sure you use us as a reference.
Have a great holiday, everyone. Talk to you next year.